You were
Can't hear
in
me.
and out there, Jeff.
Okay, so can you hear me now?
You're back.
There we go. All right, tab
Yes.
5, core fixed income asset class review.
Thank you, Mr. Chairman. I'm John Ramoski, the Director of Fixed Income. Joining me here today is Kirsten Haswell. Kirsten just got her 10-year PIN in the 1st of August. Also joining me is Ethan Kittle. Ethan Kittle joined us a year ago in February. And just recently in the 1st of May, Jesse Zeiderfeld joined us. As an interesting aside, I didn't want to wake Joanne up this morning, so I kind of got dressed in the dark and grabbed the wrong suit jacket. And this suit jacket is older than Jesse and Ethan. So, but still.
Is that combined or separate?
The combined one unfortunately does not fit anymore. We're going to go over the fundamentals of fixed income. We're going to talk about an overview of our philosophy, and then we're going to demonstrate some of the mechanics of how we execute that philosophy. And so with that, I'm going to turn it over to Jesse.
Hello, Mr. Chairman, members of the board. As John kindly introduced, my name is Jesse Zeiderveld. I'm the newest analyst with the fixed income team. Very excited to present to you all today. So I'm going to be going over just some fixed income basics, terminology, and things that we consider when we are transacting. You can think of fixed income essentially as lending. An investor is providing capital to a borrower, whether that is, in our case, the US government or a corporation, in return for contractually scheduled payments over time. Now, except for a few select portfolios, the Board of Investments cannot own private capital stock. While this may seem like a limiting factor, it is actually not. While a publicly traded company typically only has one stock that an investor can participate in, certain companies can have hundreds of fixed income instruments. In the case of Verizon, the company that we'll be taking a closer look at today, there are over 400 asset-backed securities and corporate issuances that investors can purchase over certain, amounts of time. This kind of gives investors the ability to be more selective when it comes to their confidence on a company's performance over time. As well, another kind of added benefit of these fixed income instruments is the fact that they sit higher on a company's capital stack, meaning a bondholder is going to get paid back faster than an equity holder. Heading to our next slide. So when we're looking at a bond, there are several key things that we think about. There are terms on this page, but rather than tell you about all these definitions, I'm going to use this bond here as an example to kind of explain some of the things that we look at. Here we have a Verizon 4.78% coupon bond maturing in 2035. And on the screen, you can see this is the description screen, which shows kind of a lot of the overview information about the bond. So starting off with principal, this is also known as par value. And this is the value that we can think of an individual bond as. So it's usually $1,000. The coupon rate is 4.78%. And that is the amount that the investor will receive each year until maturity, which is when they receive par. Yield is going to be explained more on a later slide, but this can vary pretty significantly from coupon, depending if the bond is purchased at a premium or at a discount. Some other things that we consider are economic sector and asset type. Economic sector gives us an idea of how a company is performing relative to its peers. For a company like Verizon, this might include Comcast, T-Mobile, or Disney. Asset type further helps us specify the level of confidence that we have in a company. For something like Verizon, if we wanted, additional security for our purchase, we could look into their asset-backed securities, which for them, would be backed by phone plans. Heading on to our next slide, we discuss credit ratings. So the NRSROs assess a company's ability to repay these coupons and principal over time. everything that we participate in on the fixed income team is considered investment grade. However, beyond that, we also do have our own internal rating system that we try to update semi-annually for every single company on our approved list. And that's going to be kind of explained in more detail later in our presentation. Looking at the credit ratings across an entire portfolio gives us an idea of the average credit quality. So how well our portfolio is going to perform over time, or I guess how well they will be able to repay their contractual payments. Another important factor that we look at is called duration, which is a figure that quantifies the relationship between interest rates and a bond's price. A longer or higher duration indicates greater price sensitivity to changes in interest rates. The duration of this Verizon bond is around 6.8, meaning that a 1% increase in interest rates will reduce the price of the bond by approximately 6.8%. While this is a percent change, a measure of percent change, we can also look at weighted average life, which is a measure of time, and this tells us how quickly we will receive our money back, basically, as an investor. And then heading on to our next slide. Like we discussed before, coupon rate and yield often vary depending if the bond is purchased at a discount or a premium. For this Verizon bond, if we look up where the mouse is, we can see that it's currently trading at a discount or below par value, meaning that the yield an investor would receive would be closer to 5.55%. For corporate issuances, we typically use the US Treasury curve kind of as a basis of comparison. So by seeing how much more yield we receive above the comparable US Treasury, we can understand the additional risk premium being assigned to this bond. This Verizon security has a spread of about 105 basis points from the last time that I looked, meaning an investor would receive about 1.05% more per year than if they were to invest in the risk-free comparable maturity treasury. While investment grade issuance typically have tighter spreads than high yield, there are a multitude of factors that can determine this, including the issuer, sector, maturity, etc. I will pass it over to Ethan to explain these risks more in detail. Thank you so much.
Thank you. All right, thank you, Jesse, and good afternoon, members of the board. I'll be with you all for the next few slides covering more fixed income basics, starting with key risk factors. And the main idea I want to get across from this slide is that every basis point above the risk-free rate is compensation for taking on some combination of the following risks. With that said, these risks can be broadly categorized into two main groups: risk tied to the market interest rate and risk tied to the specific issuer and issue itself. So starting off with that first group with the real risk-free rate. This is the return a lender demands above inflation on a theoretically zero risk investment, and it moves with aggregate preferences to lend versus spend in an economy. Next is inflation risk, and this is the risk associated with inflation eroding the purchasing power of the bond's cash flows over its life. And a quick illustration here, a 5% coupon feels very different in a 4% inflation environment versus a 1% environment. Then we have maturity risk, and this is the risk tied to the length of the lending agreement. So all else equal, longer the lending agreement, the more the bond's price will move with changes in the market interest rate. And this is because the bond's fixed cash flows are locked in for a longer period of time. Moving to that second group, starting with default risk. This is the risk that the issuer will fail to make those contractual principal and interest payments. And this risk is directly tied to the creditworthiness of the issuer. And finally, liquidity risk. Put simply, this is the risk you won't be able to sell the bond quickly or at a fair market price. And this risk can get worse in times of market stress, and that's often when liquidity is most desirable. So to sum this up, we do not try to avoid these risks. We choose how much of these risks to take, and we do our best to make sure we are getting compensated appropriately for bearing them. With that, I'll pause for any questions on risk.
I have a question.
Yes, sir.
The risk-free rate, what are you
Yes, sir.
using to determine the risk-free rate, and does that change?
That would be US Treasuries,
US Treasury?
and that will change with the market
The
and
market, yes,
Yes,
okay,
yes,
but
sir.
you're using US Treasury at what length?
it depends on the length of the bond you're looking to buy.
Okay,
So
it
you wanna
goes-
match that
you
maturity.
match those up, okay, thanks.
Yes, sir. Any other questions? Hearing none, we can move to slide 8. We'll touch on interest rate sensitivity. And the big idea I want to get across from you to you all here is that a fixed coupon never changes, but rates on newly issued fixed bonds change constantly with investors ever changing demand for compensation for many of these risk factors we just walked through. That's why the price of an existing bond has to adjust until its total yield going forward is competitive with what the market has decided is the appropriate interest rate. That's the mechanism the seesaw is describing in this slide. So the big takeaway here is rising rates hurt current bond returns and prices, but help future returns and income. This is because we are now investing in a higher interest rate environment, and the reverse is also true when rates fall. That's the seesaw dynamic. Any questions on that? Hearing none, we can move on to slide 9. Where I'll draw your attention to the left-hand side of the page first, where you'll see all of the different portfolios we manage on the fixed income team broken out in the pie chart. I'll point out CapCore, that's the portfolio we're reviewing today, makes up just approximately 15% of the total assets we manage on the fixed income team, with those assets totaling $15.2 billion. Moving over to the right-hand side of the page, you'll see some transaction information. You'll note we do quite a bit of trading on the fixed income team, with the lion's share being in the STIP portfolio. And this makes sense intuitively given STIP is a shorter maturity portfolio on average, and therefore its holdings turn over much more frequently. Compare that to CapCore, where it has a much longer average maturity. Its holdings are going to turn over much less frequently. I'll pause for any questions on slide 9. All right, hearing none, we can move on to slide 10. We'll discuss portfolio objectives. And this slide kind of brings everything we have reviewed thus far together into 3 primary objectives for the CapCore portfolio within the overall pension portfolio. Starting off with total return. This can be grouped into 2 primary sources, the income component and the market value change component. That first component is highly predictable. We know when we're going to get these cash flows from coupons, and we can forecast them with a good degree of accuracy. Now, market value change of the bond is much harder to forecast with a high degree of accuracy. But for us, this is not a primary concern, as over the long haul and across business cycles, price is mostly noise, as a bond will ultimately mature at par as long as the issuer does not default. Therefore, starting yield will determine the lion's share of return. Moving to the second objective, diversification. The goal here is to enhance the overall risk return profile of the pension portfolio through fixed income investing. And fixed income does this by bringing a different risk profile than many other asset classes, as it comes with a contractual obligation from the issuer to be paid back principal and interest in the future. Compare this to other popular asset classes like equity, where you simply have a claim on future firm profits, and you can see how the risk profiles differ meaningfully. Couple this with that rate seesaw dynamic we discussed earlier, and you can see how bonds can often, but certainly not always, zig when other asset classes zag. And finally, we have the goal of liquidity. And put simply, we would like the portfolio to be liquid enough to tap in times of market stress, to do things like pay pension benefits or rebalance into other asset classes. And this is largely accomplished by holding nearly a third of the portfolio in US Treasuries, arguably the most liquid market in the world. In addition to this, the portfolio naturally creates liquidity through bonds maturing and coupons being paid. With that, I'll pause for any questions on portfolio objectives. Awesome. Hearing none, I will pass it along to Matt to touch on compliance. Thank you all.
Mr. Chairman, members of the board, good afternoon. My name is Matt Hoffman. I'm part of the operations team and we'll be going over compliance with you. So to start, we utilize Bloomberg's Compliance Manager or CMGR application. And this allows us to take all the IPSs from the various relevant accounts and translate them into rules. Now, these rules are implemented every time fixed income submits a trade to ops. And as you saw previously, the volume of trades, this would be virtually impossible to check every trade by hand. So this really increases our efficiency in doing that while eliminating some human error in the process. But this isn't the only function. It gives the trading team the tools to see the portfolio as a whole. If there's any restrictions coming up or an issuer has come up to their limit, they can trade around that real-time data. It's not stagnant. It's actionable. Now, if a policy is updated, it is really easy to switch that and update it in CMGR, but it does take an approver. So if you're a trader, you can also make changes in it. This just helps our separation of duties, further enhancing our compliance.
So this is a list of your rules for all your, it's not
Correct.
just your fixed income, right? This is everything.
Correct. And then each account, so STIP will have a set of rules. Core fixed income will have a set of rules. Any account that can hold it has. So there's MU 36.
On the rules.
Yes.
108 rules.
So when you're transacting a few times a day or more, checking all those by hand would be a full-time job.
That takes seconds in Bloomberg.
So this automatically does it then, based on all the,
Yeah, we cannot push a trade through without running compliance. It does it
Who's
automatically.
authorized to approve rule changes then?
So any of the provers, so I think Tim or I at the moment
Okay,
can.
okay,
And no one on fixed income.
No. If you have the trader specification, you can't. And then conversely, if you have the approver specification, you can't trade.
so Bloomberg administrator then would be
Matt.
Matt
Yeah.
and
Tim.
Tim.
Yep.
Interesting.
So quick crash course in CMGR, but
Really quick.
Yeah.
as, yeah.
Could you just summarize each one of these rules?
Quick.
Here's all our policy statements.
Good job.
Any other questions on it? It's a simple tool, but it's powerful for both the teams.
So did you guys put the criteria together to go into those columns?
It's all approved by the board via policy statement.
Yeah.
But you decide, we approved it, but you decided what was gonna go in, for example, particularly the description column? Right?
Right,
Yeah,
right.
We're translating that policy into
You do.
the rule.
Very
Into
good.
as it follows the policy.
So what is it, what does the rest of it say for like a maximum of something or corporate, well, it's getting smaller and corporate.
Yeah, so,
Kristen, are you able to hit that pencil?
I-
You might not be able to.
I don't think.
Over on that.
Because she's not an administrator.
Yeah.
I'm just kidding.
Yeah,
Well,
I
um,
know.
but all that stuff you
yeah,
Wow.
abbreviated the basics of it, I suppose, in ways.
Yeah. yeah, so like this rule here says,
Stip approved list.
there's another list that lives inside Bloomberg, so it has to be on that list for us to be able to buy it in
Ah.
STIP as well. And so this references that other list as well, so, things like that.
so. You told throughout the organization, there's 108 rules. That's what, is that correct? Not just fixed income. This is 108 rules.
This is
I-
just.
I think that-
Yeah.
Oh, this is just STIP,
I mean, it's
108
closer to
rules relative to
300.
STIP.
And STIP probably has the most, I think,
individual.
because there's a lot going on there.
So how do you ensure that there's not any changes from the policy statement to that? You know, do you have a method to make sure what's approved on the policy statement is what's on here?
Yeah, so every time there is a new policy or it's modified, we will go in and change all of them. But if there's not, we don't.
And there's an audit trail in here,
Yeah.
which I also can't pull up since I'm not an administrator.
Who changes what and when? If we need that record, but the only reason we would be changing it is if the board approves a policy.
Do auditors or is this Whitfleet look at this?
Whitley looks at this, yes.
Okay. All right.
But
This
there's
is more on the SOC side than the LAD side.
several layers of checks and balances there.
Yes.
So if there was a change, you could have to go in and change all of those?
Correct.
Good Lord.
Well, most of the time. So most of the time, let's say we bring a STIP policy change to you. You know, we say, oh, we want to add more asset-backed securities. That would only be
Potentially one of them.
potentially one of these. I mean,
Mm.
they would know that.
They know which
We're
one.
not typically rewriting the entire investment policy statement. We're
Just a piece. we
doing
just-
some little piece or something. Yeah.
Correct.
So those were all modified in, what's that, 21, June of 21? So there was a new policy thing there or something?
You missed it, but we did a complete review of every governance policy
In 21?
in 21,
That was before
modified
me, you
everything.
know.
It was, were you here for that?
I was here. that was
Yeah, we
fun.
I remember.
we did a line by line review of every governance policy we had.
I had
You
to
fixed all the grammar.
magnify everything.
Yes, that's where the verb magnify comes from.
Okay.
Well, if there's
Glad
not
we did.
any other questions, I will turn it over to Kirsten.
I'm sure. Have no doubt about that.
All right, so we are on slide 12. Going to talk about our investment philosophy. Really, the philosophy exists, so when we're reviewing trade ideas on the team, it's not what are the vibes today, but instead, does this fit our goals of capital preservation and income?
What are the vibes today?
Yeah, like what, you know, how are we feeling? That's not what we do, right? You know, and does this add value to our active management? As long-term investors, we're focused on long-term value add. So when we say active management, it means two things. One, we're not constantly flipping and trading securities. You saw how many trades we do. You know, the long-term portfolio is significantly less than STIP, which is the short-term portfolio. That's on purpose. We do a lot of buy and hold. And two, we're not indexing. The Bloomberg Ag holds over 14,000 securities. So that would be really hard to do, really hard to replicate, especially with a small team. So that's what we mean by active management. Are there any questions on our investment?
That's why we have those higher up managers in this office, right? Those other managers that are looking after everything in Bloomberg,
Right.
and telling you, this is what you're invested in and how it's doing and what we do and what you're supposed to do and. Geez,
Yeah.
this is enough to give people like me a headache.
I just don't recall seeing an investment policy statement, something about we do not follow the vibe of the day.
Yeah, maybe we should write it in there, right?
I will phrase in the affirmative, not the
Right.
negative.
Okay, so more good news, we're cheap. Slide 13, looking at our costs. If we're just looking at that cap internal core fixed income, our costs are about 2.3 basis points. Most easy apples to apples comparison would be an external manager, investment grade fixed income manager, which you can see would be 24 basis points. If we put these dollar figures on this, I think it makes a bigger impact. You know, our $2.1 billion core, that means we pay about $480,000 in fees to internally manage this versus about $5 million per year to an external manager. Of course, this is on $100 million separate account, so I would say there would be fee breaks if you had $2.1 billion, but it's probably still in the millions of dollars difference here. So do like to point that out. You can look at the ag and say, well, yeah, you could just own the ETF. That's also cheap. That's 3 basis points. You're giving up, you know, some outperformance here. Our core fixed income tends to outperform by, you know, I think it was about 28 basis points of performance annually, which is real money as well. And also you give up all the control here. You own those 14,000 securities. If that's what the ag owns, that's what the ETF owns. I give an example from a couple of years ago. Pfizer was on our approved list. We had bought a new issue that had been issued out of their Singapore entity. Well, as soon as we heard the Senate Finance Committee was investigating Pfizer because of that entity and their tax issues with it, we said, we don't want to hold that anymore. We sold it and we bought into one of their US based issues instead. We get the control being on the team, making those decisions. If you own an ETF or indexing, you don't get to make those decisions, especially not quickly. So there's an example for you. Are there any questions on our costs? Again, just we're cheap. Not fun to say, but you know, true. You may think we're cheap just because, you know, we have a small team. Maybe we're understaffed and we need more analysts.
Nope.
That's okay. Right? Well,
That's going into performance evaluation.
On one hand.
so you've met the fixed income team now. But a little later, I'll show you kind of how our team specifically is leveraging AI. You know, we also get to participate in discussions with external managers, particularly high yield real estate, real assets, private credit. We don't trade in a bubble, so that's kind of a sounding board for us to find out what else is going on outside of just investment grade fixed income. You got to hear from Matt, so you know, operations, risk management, we get a ton of help from them and from our accounting staff. We always think it's kind of a lopsided benefit wise. We can only make things harder for those teams, but they can make things a lot easier for us. So we always have to give them a shout out because we appreciate all of their partnership. So are there any questions on the slide number 14? John, I will hand it over to John.
Hey, I'm sorry, I do have a question.
Sure.
And forgive me, this is pure ignorance. I forget how it trades. Do we trade directly or do we have or do we trade into to different brokers? I mean, at our size, I would imagine we trade directly, or how does that work?
Yes, we trade directly.
Thank you.
Yep.
Awesome.
Yep, so just to flesh that out a little bit, John, is we almost always do our trades in competition. So electronic trades, bidding competition, feel like we get the best value doing that. Looking at slide.
But there's no research, there's no trading with a certain group to offset with research or anything like that. We trade direct.
Right, no soft dollars.
Yeah, thank you.
Yep. Looking at slide 15, so why don't we just outsource this? This is why we believe that we're better than outsourcing it. Kirsten talked about a lot of this, but let's just flex, maybe flesh out the experience. Combined, we have probably 50 years of experience. Kirsten and the majority of that is unfortunately me, but Kirsten's been here 10 years after a near decade in private wealth. Ethan spent a couple of years at our valuable consultants before he came here. Jesse spent a couple of years at one of our brokers at StoneX, so they have experience outside that can be valuable, and some of that value has been put to use right away, especially with AI and some other machine learning coding that we've gotten from both Ethan and Jesse. So I kid them for being young, but they've added a lot of value in short order. And also, you know, we're very much believe in training by doing. So we throw them into the fire fairly quickly and get them up and running quickly. Kirsten mentioned our low cost structure. You know, that does add up over time. We have the well-defined process that John and I have been dealing with for 20 or 25 years. So that process doesn't change. And then control. Again, Kirsten talked about an example, but another example is if, for instance, if John wanted to express an opinion on the direction of interest rates, well, he wouldn't really be able to do that with an external manager. That's their bailiwick. But with the internal pool, he could direct us to go long or short duration to help express that opinion. With that, I think maybe we'll go through some of the mechanics of how we execute that philosophy. And so I will turn it over to Kirsten.
Great. You've heard us mention a couple of times our approved list. We're going to walk you through an example with one of these. We do not buy corporates that aren't on the approved list. Talk about how a name gets added to the list. A fixed income team member brings credit research to one of our internal credit meetings, and then we defend it. There has to be consensus on the team to add. The whole room, right, agrees. Whereas removal from the approved list, that's easy. Any team member at any time can remove a name from the approved list for any valid reason, valid being key here. And that's just because of the asymmetry between, if you think of behavioral economics, it's hard to sell a loser, especially if you're the one that bought it really hard. Whereas, you know, John has no problem saying, oh, Kirsten, that was a dud, let's sell it. So I brought up, this is our credit matrix. This is for Verizon again. We have had this on the approved list a long time. So you can see, you know, back, you know, 2017, I want to say is this back, you know, back when we kind of started this process of how we did this. 8 broad factors. There's a numerous underlying metrics that go into this. This takes a lot of time. There's a lot of numbers to pull. We have to write our own comments here, you know, details, manually updating it. It was a lot of work and took a lot of time to review a name on the approved list. We kept our approved list to right around 100 to 120 names. Couldn't add any more than that. So now I can show you how we do it now. This is with AI Perplexity. So you're going from that one spreadsheet to now this very long, detailed report. Kind of we feed the data into this. This is all, you know, from the financial statements. And the skill assembles everything for us and gives the rationale and all of this. Longer output to read, but dramatically faster. Something that used to take us a couple of days to put together takes maybe an hour now. So significantly different. But why you can't fire all of us and have one person just run these and then determine trades. The raw output for this Verizon ended up giving a -2 using our metrics, which would be below investment grade. So we would not buy it. We would not look at it. We'd take it off the list. So since Verizon is my name, I went through and I was double checking all of the outputs here. With some analyst overrides, it actually comes out to a +1. I'll give you the 2 examples in this report of why this happened. The AI was super upset about a recent network outage with Verizon, and they double counted it, well, probably 4 times in this document and gave them a penalty each time. Once I removed all the double countings, that brought it up to a 0. And then another one, there was a one-off read that it determined was a trend, and then penalized them for it. I looked through at the financial statement and said, no, there was a special one-off financial write-off. You can't say that's a trend, take that out of there, and now they're a +1. So
Kristen, you could manipulate this.
you could.
I mean, you can.
Absolutely, yeah.
So, and I'm not saying you did,
Yeah,
or you would.
yeah.
I'm just saying you could though with
Yeah. And you could do it, you could do it on our old matrix as well.
Sure, I guess you could, yeah.
You know, and so I guess the main, I guess what we'll say is, the AI applied all of our tools literally. And then it took, you know, an analyst override to say, you know, the AI isn't broken, but as an analyst, you can't look at it this way because, you know, it can put all this data together for us and give its own rationale, but we can say, you know, that's not quite right.
But in the end, it's the whole team that decides. It's not just.
Yes,
one.
yes, and you still have to debate it. And I will bring up, we haven't retired the old way. Very important, you know, point to make here. Jessie still gets to do her names the old way. And any intern we have also gets to do it the old way. And that's because it is really hard to review AI and make those kinds of analyst decisions if you've never pulled the numbers and calculated it yourself, written the comments yourself. The AI can make an experienced analyst faster, but it cannot give experience to an inexperienced analyst. And so she still gets to learn with all the old metrics and the old way, as we call it. But we can't retire it completely. And we say at our house a lot, trust but verify. You trust what the AI is giving you, but you need to verify those numbers. So
That's what I was gonna ask you. I mean, so
yes.
if you give this to John, you guys meet and look at it, he's gonna see that -2, I think. And now it's a +1.
Yeah.
I mean, so he's gonna ask some questions about what
Yeah.
changed
And I can, sorry, I got
That
to
makes-
scroll. I have to go down quite a ways, but I see, so I put my notes in here. As we're going through the review, I know why I changed the things I did, and I can see where it is, and it saves it in the document here. Kind of funny also, if I use, say this report, then I'm doing something similar like T-Mobile, it might see that don't count a one-off as a trend, and it probably learns from that and then, you know, doesn't and puts, you know, gives me a heads up in the comments that you may score this differently. So, you know, but huge time saver for our team. Why I'm not asking Dan for another analyst for the team. You know, really great here. I guess, are there any more questions here?
It scores each one of those then?
Yeah, so there are 29 metrics that roll up to those 8 overall scores in here. And that's the same way the old one was as well. In this worksheet here, there were also 29, but again, we are pulling these manually, calculating a lot manually. So again, just a huge time saver for us. Yeah.
Pretty
Yeah.
impressive.
Yeah.
It is,
And again, a lot more detailed.
how you make things. It's nice to know there's a good process.
Yes, putting that AI to work for sure. Awesome. Well, I am going to hand it off to Ethan to show a trade example as well.
All right. Hello again, members of the board. I'll be with you for a quick demo where we will walk through what we look for when we are evaluating and creating opportunity. So what you're seeing on screen here is the fixed income worksheet tab on Bloomberg, and it plots every bond an issuer has outstanding on one chart. And here you're seeing Verizon on screen with G spread plotted on the y-axis and maturity on the x-axis, with bubble size representing issue size outstanding. So the bigger the bubble, the larger the issue size. And you connect the dots and you get what is called Verizon's credit curve. It represents what the market demands to lend to Verizon across time above the
Sorry.
theoretically risk.
Court sent me something.
You should have to buy donuts or beer.
Oh, we know where that beer comes.
Yeah, we do.
So let's not bring that up.
I thought it was Kristen there for a minute, because I'm looking at the screen over there.
I'm too thinking,
Here,
what
I'm
the
sorry.
heck?
As part of.
Added a little excitement.
Yeah. So you connect those dots and you get the credit curve, and this represents what the market demands to lend to Verizon across time above that theoretically riskless alternative US Treasuries. And this ultimately makes relative value more visible for us on screen. So jumping into the trade itself, we're looking at selling out of the Verizon 5.05 2033 bond and buying into the Verizon 4.78 2035 bond. And so starting off with what is staying the same with this trade? Well, it's the same issuer, both are Verizon, and it's issued out of the same legal entity. And this is important because different legal entities carry different creditworthiness. And it's the same ratings from the various rating agencies and has the same embedded call structure. Both are callable several months prior to maturity. And so what's getting better with this trade? We're picking up just about 20 basis points of G spread, or about 34 basis points of raw yield from the same borrower. And we're going into a lower dollar price bond. And this matters because in the event of a bankruptcy, you can only get paid back par. So at the margin, that lower dollar price is more attractive. We're also going into a bigger issue size outstanding. We're going from about 1 billion to 2.2 billion. And all else equal, the bigger the issue size, the more liquid that bond issued. That makes it easier for us to transact in that bond if we so desire. And that's that liquidity risk factor at play in real life. And we're also moving to a more attractive, cheaper part of the credit curve. Simply put, we're moving from a bond that's trading below that regression line to a bond that's trading above, and relative to its neighbors, it looks cheap. So what does this trade cost us? Well, the primary cost is the extension and maturity. It's about 1.7 years of maturity extension, and that works out to about 1.3 years of modified duration, additional modified duration. So we're moving into a more rate sensitive bond. So how do we determine if this is a good trade? Well, the standard we hold ourselves to on the fixed income team is that we would like roughly 10 basis points of G spread pickup per year of additional duration added. And I want to stress this is a heuristic. It's not a hard rule, but it provides us a rough starting point to determine if a trade is workable. So for this
10 basis points per additional maturity?
additional years of duration, modified duration. Yes, sir. So for this trade, we're extending about 1.3 years of modified duration. That means we have a hurdle of about 13 basis points of G spread to pick up on the trade. And with this trade, we're picking up about 20. So we're comfortably clearing our hurdle, and we're objectively getting into a more attractive bond. So to sum up this trade, it's the same credit quality with better bond terms, and it clears the standing rule we have for ourselves around G spread pickup comfortably. And that's what a strong relative value trade looks like for us on the fixed income team. Happy to take any questions on this.
Was this a hypothetical?
This was a real trade we executed.
And how much real dollars does the board have invested in this? That one you just talked about?
So we've executed it partially, I should say. I want to say we have 15 million left of that 5.05 bond, and we have gotten 5 done into that Verizon 4.78.
Can you click on that one?
The 505?
Yeah, I just wanted to look.
So, the bond that you trade out of, so did that bond just drop off that curve? And then that's why you're looking at it and making the trade?
We bought it new issue back in 2023, and it's just been tightening since.
Came off the curve.
And I'll add, this is also that Verizon 5.05 2033 bond is a green bond. So that makes it more desirable. It's environmentally friendly. So that could be why it's trading tighter. Could also just be market mispricing.
And when did you do that one? Just,
A couple weeks ago, I
May.
wanna say.
oh no, what was that?
And like I said, still working on executing it, but you know, we have a pretty large order relative to the volume these bonds do, so it takes time to work the trade at a good price.
Geez, I'm gonna apply for a job here pretty soon.
Right, so fun, right?
Fun job.
It is.
Your openings in fixed income despite their best efforts.
But I said I'm not asking for another analyst.
Well, if there's no other questions on this, that'll conclude our demonstration and presentation. Thank you all for your time and attention and for this wonderful job.
Yeah.
Interesting, thank
Good
you.
information, thank you. I thought. Looking me into it here.
Well, you
All
were-
right, thank you, fixed income team. Any other questions? All right, let's move on to tab 6, RVK.
Good afternoon, everyone. We've got Becky online also, just to point out.
Oh, you're not doing solo.
Well, you know, I'm here in person by myself. Actually, I just got my new badge, so I've got Becky and Jim here with me. Represented in the room.
Right.
Yeah. So we're talking about second quarter performance today. I am on the master page. It's 84. It should look like this, just to make sure we're all looking at the same materials. Is that what you have in front of you? Perfect. This is capital markets review in the upper left corner as of June 30th, 2026 in the upper right corner. So as a reminder of where we left things the last time that we talked about performance in capital markets in general, at the end of the first quarter of 2026, we were recapping what had been a pretty rocky quarter for the capital markets. In particular, public equity saw a pretty large drawdown in the first quarter. And as a result, that did have a negative impact on your portfolio. Fast forward to the end of the second quarter of 2026, we did continue to see volatility within the quarter, but we saw very, very strong performance from really all of the major asset classes. With public equity, that's encompassing US equity, international equity, both developed and emerging, all posting very strong double-digit returns. So to pick a few of those out, in the lower left corner where it says market performance for that quarter to date column shown, we can see large cap equities represented by the S&P 500 index returning around 15% for the quarter. Small cap equities, that Russell 2000 returning 21.5% for the second quarter. And on the international side, for large cap, return of 10.8% for the MSCI EAFE index. That's representing developed international equities. On the small cap side of things, for international, 9%. In emerging markets, taking the cake with an exceptional return of 24% for that second quarter of 2026. So what led to these very strong positive returns that we saw in the second quarter? What's interesting is it's pretty much the same conversation that we were having during the first quarter. The questions being, will we continue to be at war in the Middle East? And what is going to be the continued impact from AI? And we continue to live through those same things and these themes in the second quarter. And really what led to these positive returns that we saw were that signs were pointing to there being de-escalation in the Middle East, and signs were pointing to there continuing to be strong positive investment in AI, and there to be a positive outlook for AI's impact on the broader economy in general. So that's really what led to the public equity returns. Again, we did see strong positive returns across the spectrum. So a positive return from core fixed income with the ag up 0.67% in the second quarter, as well as strong returns from diversifying asset classes. That's going to be your real estate, your infrastructure, your private investments in general. The one red number that you do see here in that quarter to date column is the Bloomberg Commodity Index, with a negative return of about 8% in the second quarter. And really, that's just the impact that we saw energy prices come down in the second quarter. Energy being the largest component of commodities in general is what drove the negative return that we saw come through there. Let's see, outside of those major asset classes, what else happened in the second quarter? I'd say inflation continues to be a major theme that investors are keeping their eyes on. We did have a new Fed chairman, Chairman Warsh, sworn in during the second quarter. He's just across the state over in Jackson Hole, I believe, this week for the symposium being held there. And it's always interesting to see a change in regime when we see a new Fed chairman come in. Traditionally, the Fed has relied on having a lot of trust with the market in general and being very transparent. And that is the big question that everyone's looking to now, is just how much data are we going to continue to get out of this new Federal Reserve? Because really you need to have the two-way street, right? We need to trust the information that's coming out and have confidence in what we're being told to continue to make these long-term investments with the Federal Reserve in general. So I'm going to focus, actually, we don't talk about the key economic indicators, but I think they're pretty relevant this quarter and do a pretty good job of summarizing everything that we have our eyes on at the moment. So this is the upper right-hand box with all the bars with the blue dots on them. So starting on the far left, we have the unemployment rate shown here. And what the blue dot represents is the current level for that economic indicator relative to really what the range has been historically for where that economic indicator has lied. So when the Federal Reserve is looking at making decisions, they have this dual mandate of they're trying to maximize employment and they're trying to keep inflation near this 2% target level. So I can see if I look at that blue dot for unemployment rate, unemployment sitting at about 4% as of the end of the second quarter. We're actually in a pretty good place if I look at that economic indicator alone. So 4%, it's not full employment necessarily, you know, there is still some degree of unemployment that exists, but it's about as darn close as you're going to get probably to having the workforce fully employed. And you can see following on the bottom half of that range here, it's a pretty strong place to be relative to where we've been historically. If I look over at the second economic indicator shown here, that's the CPI, the Consumer Price Index, and the year-over-year change of that index. So as of the end of June, the CPI, the headline rate, was at 3.5%. So again, a little bit elevated. It's not that 2% level that we know the Fed is trying to target. But relative to the range, you know, if you think back a few years ago when we were sitting at 7-8% on a year-over-year rate of return or rate of change, we have seen CPI come back down. And that really is what continues to be the conflict at the Fed at the moment, the question is inflation continuing to run too hot? And does some action need to be taken? And it's really that inflation figure that's being debated over, right? Is this a number that's concerning? And the Fed is telling us at the moment that they're happy with where things are. So the most recent meeting that occurred, there was no change that came through to the rate. There was some dissent amongst the group, with some members of the group raising their hand saying, I'm a little concerned. You know, I think maybe this is something we should be looking at. But overall, the group decided not to take any action there. So that's a story that's going to continue to unfold as we move into the second half of this year. And it will be interesting to see, as this new Fed chairman gets some time under his belt, what kind of information we see come out of that group. The third economic indicator here, I'm going to call out because it's very relevant. We did see big news break in the last few weeks that the federal government has, for the first time ever, surpassed the debt level of $40 trillion. So it's it seems like a made-up number, right? What does $40 trillion even really mean? But it has had implications on the bond markets. I should bring the bond guys back into the room here. But it's been interesting to see how that story has unfolded. Again, when you're issuing a really long-term bond, you're essentially issuing it with the full faith of the US government, saying, we're absolutely going to return this money at some point in time. And there's I don't want to be the skeptic, because that's not my job, but there's this question mark that is continuing to grow, right? Is what level of debt is sustainable over the long term. And when we look at the Treasury yield curve, which is in the bottom right-hand corner here, again, the supply and the demand dynamics across and what defines the shape of that yield curve is really on the short end. That's the Federal Reserve setting that target interest rate, saying we're going to target rates between maybe 3.75 and 4%. And that's really an anchor on the short end of the yield curve that does not tend to be deviated from too much. When we get out on the long end of the yield curve, down towards that 20, 30-year end of the curve here, that's really the supply and demand dynamics that are coming into play. And that's the story that's going to continue to unfold with the government debt here, as the market is essentially saying, we're going to need a higher yield from you if you're going to continue to want us to buy these bonds from you. So that is the movement that we've seen on the long end of the yield curve there, which is something that the Fed is also needing to keep their eye on, right? If we think about the dynamics of a normally sloped yield curve, it doesn't make a lot of sense for a short-term and a long-term investor to be compensated at the same rate. So that is one of the stories that's been playing out the last few weeks in the fixed income markets in particular. So that's the backdrop kind of in my mind, right? We look at these economic indicators as this is playing into everything. And then how is it spitting out for how the market is reacting and how the average American consumer is feeling. So the fourth indicator we have shown here, that's the VIX index. So this is really a measure of how volatile markets have been. In particular, it's a US equity indicator. And you can see that the VIX, that blue dot there again, is about in the middle. It's between those two darkest gray bars, would say median average result over time. So it's interesting as we're continuing to see these kind of cracks, question marks pop up in the economy in general, but without much of a reaction from the markets. You know, we're continuing to see pretty strong positive reactions from the market performance in general. Consumer confidence is a little bit on the low side. The last bar shown here on the far right, with that blue dot being in the second quartile. You know, I think that is for a lot of factors. You know, inflation does continue to weigh pretty heavy on the average American consumer and how they're feeling about their wallets today. But I'd say those are kind of taking everything, you know, comprehensively. That's the stories that were playing out in the second quarter and that have continued to play out as we move past then. You know, taking a step forward, July was a little bit of a negative month for the markets. And then August has been positive again. So we kind of continue to be on this seesaw of having economic data come out and seeing some kind of impact on the markets. And then things kind of tend to go back to business as usual. So again, thinking back to the end of the first quarter, the good news for you all as a board is we did see a weak quarter in the first quarter, as we would expect you to, and as your board and your consultant and staff are all on the same page of doing. You stayed invested at your asked allocation. You know, you didn't exit public equities when you saw a drawdown, and as a result, you did see a really strong positive return for the total fund in the second quarter of 2026. So sticking to that long-term plan and staying diversified really paid off for you in the second quarter.
Thank you, John.
Yeah, we give all the credit to John. I will pause there on the capital markets and take any questions from the board I can before I move into your particular performance for the second quarter. Or Becky, anything I may have missed that you want to hit on? Feel free.
Great. Great job, Paige. Nothing to add.
Okay, so I'm going to fast forward to page 5 here. It says MBOI performance highlights, total fund at the top of the page. This is our executive summary. Again, this executive summary focuses on the public pension component in general. So you can see we did have first and foremost a positive absolute return for your total fund in the second quarter with a return of 7.4%, which brings you to a year-to-date return of 6.7%. Again, it's gonna be the public equity that we look to that was the main driver of that positive performance during the second quarter. You can see your two top performing asset classes were domestic equity and international equity, returning 15.8 and 14.2% respectively. However, it is noteworthy that every single asset class that you're invested in did have a positive return for the second quarter and did contribute to that positive return, which really we were not able to say incredibly often. So again, I would say this was a bit of an outlier of a quarter where we did see every single asset class perform relatively well despite all the volatility that took place. We did have underperformance relative to the benchmark for the quarter, with the total fund underperforming the benchmark by 145 basis points. As we've pointed to in past meetings, this really just continues to be that underperformance we've seen from the private investments composite relative to the public market equivalent benchmark that it has in place. So no new news there, something we're continuing to monitor. We've added that secondary benchmark to have another yardstick for measuring success of that program in general. But as we've talked about also in the past, we have several different metrics of how we evaluate relative success for you. So you can see for that quarter to date, relative to your peers, he's still ranked in the 39th percentile, so an above median return in that time period. In addition to that, I would point out the relative performance for your asset class composite. So we'll cover this on the next page. But again, 7 out of the 8 asset classes that you're invested in actually outperformed their respective benchmarks for the quarter. So that's every single asset class you're invested in, with the exception of private investments outperforming its stated benchmark, which is again, kind of rare that happens. And especially in a quarter, we tend to see in really strong up markets that active management struggles to keep up with the benchmark so much. So that's really just a nod to the strong implementation that you have in place in a lot of these asset classes, that we're able to balance out that impact from some of that underperformance from the private investments composite.
Well, so it raises the question again as to having the small cap as an index to track private equity. And if we're, on a big quarter like we just had, so then it shows us down 14% versus basically, or 13.5% versus the S&P versus the Russell. And so I guess, again, it's the question of how appropriate is that index, or is that tracking to use it, because that shows more volatility, and it's it shows outperformance if small cap's not doing well. But on a quarter like we just had, it's like, oh, the private equity team or the private investment team is down quite a bit. And I appreciate the Cambridge index. I think that's very helpful there. But I'm still curious. I don't quite see the, if we use the private equity, the Cambridge index to create the asset allocation, I see kind of a disconnect between using the small cap there versus just keeping the Cambridge. Does that make sense?
That makes sense. And it's a super valid point, as we've talked about for a few meetings now. I think my first comment would be, as we have noted on this page here, we do really try and focus on long-term time comparisons when we're looking at an asset class like private investments. It's really over those shorter time periods, like a 1 quarter, a trailing 1 year, that we tend to see a really large dispersion. If you actually go out on the next page, 2 pages forward, we have private investment shown in the middle of the page here, and you can see for sure we have underperformance of 13.55%.
Sure, it pulls it, but it pulls it so much that now we're showing a minus 130 basis point tracking over 5 years, and 100 basis points over 7. And sure, maybe we just focus on the 10-year number there, but again, it's just a question of why use it as a tracking method.
If I could just jump in real quickly on that question, for all of our clients that are using a public market to compare their private investments, specifically, I think your question's getting at private equity.
Correct.
You're all seeing the same kinds of results. And the theory is that your alternative, instead of investing in private equity, is to invest in the public markets. And over time, you would expect to receive a premium over the longest term. The issue that we see in the recent periods is the impact of AI and the optimism overall in technology has just bolstered public markets way beyond expectations, way beyond historical norms. So I don't think that you would take that and say, well, then because they're doing so well, should we not invest in privates? Because
No, but
it
that's
is
why we have the Cambridge Index when we do asset allocation, right? It's just
well, we do both. Yeah, we
Yes.
actually force in the asset allocation, the modeling actually looks at all available asset classes and
Sure.
the assumptions for them and
You
chooses
probably
among
have to
them.
dial it down to kind of make it fit. I guess the question is this. Is that one an all worlds stock index, or I thought it was that we were specifically saying the small cap? And I guess like I understand, hey, listen, let's have some public index tracker there because there is an alternative use of funds. But isn't like the all world, I mean, I see all world, what is it called? The all world,
The ACWI,
Yeah.
all world, yeah.
I see that one commonly. I don't see just using a small cap index. And so forgive me, is this private investments custom index? What is that exactly? Is it small cap is part of that, but is it entirely? Because then it would be,
No.
okay, thank you.
Yeah, and in fact, in your bigger report, which is the next section that we're going to go over here, and Paige will cover, the private investment custom index is a portfolio weighted average of the MSCI US small cap, as well as the leveraged loan index. For private equity and private credit. So it's blending private equity and private credit together. And in each case is using a public market equivalent strategy. So in terms of what do other plans do? Other plans also use small cap. Other plans also use the S&P for the private equity component, plus a spread. Some use the Russell 3000 plus a spread. Some use the global index, which you referred to, plus a spread. The small cap choice here is also getting a bit more towards the relative risk level that you'd be taking in private equity relative to small cap. So it has that advantage. But all these are just indications long-term of what a public market investment instead of private would have done for the private equity component. And the Cambridge, as you know, when we went through the whole philosophy of adding a secondary benchmark per previous discussions, is to give you a flavor of what actual private equity investment returns have looked like accessing the buyout and the venture capital world. You can't invest in it. And that's the other thing that the public market indices that are used in this benchmarking, part of the reason that they are used for many plans is you actually can invest in it. It is an option instead of private equity.
Yeah, and John, anecdotally, I might add, we work with numerous public pensions who there's not a one size fits all approach, right? We have clients who use a global equity plus an alpha, who use a large cap plus an alpha, who use a small cap plus an alpha. None of those approaches, unfortunately, solves the issue we've had over the last trailing 3 to 5 years of just we're in a really strong up equity market. It doesn't really matter which slice of public equity you're comparing to, that same dispersion exists over the shorter trailing time period. So again, we're with you. We wish there was like a really clean, I wish I didn't have to come here every quarter and point out again that this same benchmark was causing underperformance. But I think that's the easiest way to break down the attribution, right, is to understand. And again, we're not pointing it out and saying we're concerned with the performance of the private investments composite. We're not saying we think a change needs to happen to the benchmark. I do think it is really useful and critical for you as a board to understand what the drivers of performance are. And that is the one driver of underperformance relative to that benchmark still.
And I think that's the key here, John, right? Is there's no perfect benchmark option here. We've talked about this, ad nauseum for years and years and years. And there's no perfect option here. At the end of the day, the decision point to me is really, do we want to be in private investments or do we not want to be in private investments? And I think the answer broadly is clearly yes. I mean, the overall absolute performance is it's always been one of our best performers, if not our best performer, right up there with kind of public equities, which makes sense over a long time. But yeah, you get a lot of noise in the interim. And I would always point people towards the 10-year numbers rather than anything that's happening in the quarter of the year or 3 years. It's just not long enough time frame to be meaningful, in my opinion.
Any other questions from the board on this executive summary, the total fund, any of the asset classes? I just had a few pages I'll turn to, 5 more minutes of your time for the full report, but want to check in if there's any questions before I move on to that.
Could I just pipe in with a quick celebratory note page?
Sure.
Fiscal year to date, let's look at the actual number we returned for the fiscal year. It really was an impressive year. If we go back to the first page that had the total fund, when you look at the total fund composite, earning 13% for a fiscal year, excellent outcome. Thank you, equity markets. Thank you, investment program. That is a terrific number.
It is, forgive me. I mean, I pick on that thing because it's something that it's right from when I first joined, I pointed out as an issue. And, it's obviously an area of interest for me. It's awesome that we're almost up 7% for year to date. That's amazing. And so congratulations to the team for sure.
Thanks, John. Thank you, Becky. Yeah, and again, the other metrics that we tend to look at when we're looking at the relative success, like Becky pointed out, far in excess of the actuarial hurdle for that one fiscal year. If we look out over the longer trailing time periods here, in excess for all of those trailing time periods, except for the 5-year, which is very close. And again, over the longer trailing time periods, that's looking at 5, 7, and 10. Relative to peers, the BOI is ranking, if not in the top quartile, very close to the top quartile relative to their peers. So another strong indicator of the relative performance of this program using those two metrics as well. Okay, so I'm going to flip forward here. We're going into the next report. It's called the Quarterly Investment Performance Analysis.
Page.
It's master page 103 is where I'm going to start. It says page 9 on the bottom. Looks like this. Got the plan sponsor, total fund, asset allocation on the bottom, and some trailing performance shown on the top. So the reason I'm starting here, and again, kind of looking back to that economic backdrop that we started off with is, and always trying to put myself in your shoes of the question of, what are we doing right and what could we be doing better? The question that we're always happy to answer because I think that's a good way to be thinking about things. I'd say first and foremost, what you continue to do well, and you've always done well, is to have a diversified portfolio with exposure to many different asset classes. Times like we're in now, again, it's you have to remind yourself of just how tricky things are sometimes. When performance is really strong, and continuing to look out for where the pitfalls might be. We continue to be in a investment world where public equity is pretty richly valuated. We, will probably continue to see quite a bit of volatility in fixed income markets as some of this inflation and rate question commentary continues to play out. We continue to see some challenges in private investments, not across the board, but it's private equity, private credit making headlines, and raising some concerns on part of investors. So that's all valid, right? And it's not a reason to exit any of these asset classes. But I think it is a good reminder of just the reason and the role that they all play in the portfolio. Again, we would never look to your peers as a reason to allocate in a particular way. But I hope it gives you some sense of security to look at this chart on the bottom of the page here and see that relative to your peers, you're not like swinging for the fences in any huge way in any of these asset class allocations. So you have looked at RBK's forward-looking assumptions and the recommendations from your staff, and you've taken some small tactical plays, right? Saying maybe we're going to hold a little bit more in real estate as an example, and we're going to hold a little less in another asset class to offset that. But it's not like you're, if you go back to, I believe someone said to Dan to stay out of the paper as their advice earlier. I think that same advice applies to a board, right? As you're trying to avoid that headline risk. And you've always done a really nice job of managing that. And you continue to do that with the asset allocation you have in place. We will be bringing back, or John will be bringing back, an asset allocation recommendation this fall. And it's the same process we've always gone through, reevaluating the pros and cons and not making to look any major changes to the overall allocation, but just fine tune things if and when it thinks we make sense based off the information that we know today. I'm going to flip forward again. I'm going to go to the page 24 on the bottom. We're moving into the risk report. It says risk and return for 5 years in the upper left-hand corner. So I think building off of that same theme, this is just a really nice graphic representation of the different risk and return profiles for you have for all of those major asset classes that you're invested in. And again, just recognizing that we know that when we invest in something like public equity, we are going to be taking risk on, right? I think a famous Jim quote I always think of is you're in the business of taking on risk. As an investor and as a public allocator, you do have liabilities that need to be delivered upon at some point in time. And to deliver on those, you do need to take some risk on in the interim. We're in the business of helping you managing that risk that you do have to take on. So looking at the risk and return chart here, again, I could just go back to understanding the role that these different asset classes play. So looking at, again, I'll look at domestic equity and international equity, our superstars of the second quarter this year, and recognizing that while domestic equity, the blue dot, and international equity, the yellow dot, do lie on the far right-hand side of the chart here. I recognize they're going to have the most volatility associated with them, and they're going to be quote unquote our riskiest asset classes when we look at this chart. They also fall on the upper half of the return chart as well. So domestic equity being over the trailing 5-year period, your highest performing asset class. International equity is up there. Real assets is up there. Private investments, these other asset classes that we've talked about as having these periods of dislocation with their benchmarks or maybe lagging public markets. But when you look at holistically, it's going to be those asset classes that are driving your return and that are helping you achieve those goals over the long term. And then you're also taking different pieces of the pie and saying, I absolutely need my core fixed income. The orange dot in the lower left of the slide here, I liked it when your fixed income team talked about their role as being an anchor in the portfolio. And I think they used the word capital preservation at one point in time. That's how we think of your core fixed income allocation, as really just being an anchor that you have to allow you to take risk on in other parts of the portfolio and allow you to sometimes have a drawdown from the public equity or from the private investments and continue to stick to that long-term asset allocation over time and not force you into making any decisions that you don't really want to have to make. And you can see, I won't call it every asset class, but if you mix all of them together, That's how you end up in the center of the page here. You have the public employees retirement bolded, and taking the different risk and return profiles of all these different asset assets helps you build that single diversified portfolio that can hopefully weather any storm that you come across.
One thing, Paige, I'll just point out before we leave this page, and I love the way you covered it.
Yeah.
This 5-year picture still includes 2022, which was the worst fixed income market in the history of the aggregate. If you were to fast forward this chart to the last 3 years, this will be a different number for fixed income. It would have a better return. It would be further up the page. But just because we're capturing this 5-year period that has that historic year in it, that's why it is near the bottom, as you can see. So again, no worries, no concerns. That's just what the market conditions were in 2022 that's still affecting the 5-year numbers.
That's a good point. Thank you, Becky. And then one more page, if you slide forward one page, on page 25, we'll end here. Just as another reminder, when we're comparing you to your peers here, looking at the implementation of your portfolio, just focusing on that green sideways square in the upper left-hand corner relative to the other gray dots shown there. That is your peers, that is other public plan sponsors. And relative to those peers, you have been able to achieve a higher return than your median peer while taking on less risk for that trailing 5-year time period. I would say don't even focus on the benchmark. We know that has some flaws in this chart, but relative to your own peers that are implementing in the same way, that is a really nice implementation approach that has worked in the past and should continue to play out well for you in the future. No promises. Legal would, yeah.
Ain't no guarantees anywhere.
Yeah. So that's all I was going to cover. There's a ton of more pages in the report. I'm happy to take any questions that you have, but thought that might be the most interesting content to look at together today.
All right, thanks, Paige. Thank you, Becky. Any other comments or questions for RVK? All right, thanks. Let's move on to tab 7, the investment update.
Okay, thank you, Mr. Chairman. I am on slide 4 of the investment update here, which I don't know where it is. Let's see, it should be about
Page 183.
183.
I was gonna.
Yep.
So looking at the economic environment here, I mean, Paige covered it well. You know, primary comment here would just kind of be that the economy continues to hold up relatively well despite the volatile geopolitical and economic events that we have had transpire over the last 3 months, 6 months, year. Lots going on, but we seem to kind of soldier on. Numbers are still sort of pointing in that same direction. You know, consistent with what Paige was saying, I would say there is probably some increasing concern to a degree around the inflation picture and debt, which I will cover a little bit more on some of the subsequent slides here, but happy to answer any other questions on this for the moment, if anybody's got anything. If not, I'll move you one forward. Slide here from JP Morgan. You can see looking over towards the right-hand side of this chart, inflation has reaccelerated. That's primarily been due to energy. Bear in mind, this is kind of as of the end of June here in this particular chart, I believe. But I think it's also noteworthy, and I think this is part of what the market is starting to react to a little bit, is that, you know, we've been well above the Fed's inflation target for, 5 years plus now at this point. If you look back, it's really 2021, we were sort of last hovering around 2% or maybe a little bit below. And it's been for a lot of kind of different reasons as we've gone through time, and the word transitory was thrown around a few times at one point, and all of that. But at some point or another, you got to think that the Federal Reserve becomes a little bit concerned that you know, this becomes embedded over time, right? Because people get used to inflation being higher. When those expectations get embedded, it can be harder to make that change or bring that back down. And I think that is starting to be a little bit where we're at the moment. And
Well,
so we'll
okay.
be-
But isn't it being embedded already? I mean, a lot of that has been embedded with wages and all that sort of thing and. price
Yes,
increases?
I think so. And you can see here where, you know, we went really high, obviously, in inflation, and you can see the trend line was coming back down, and then we've had a couple of bumps back up, and then, you know, more recently here, particularly with energy. But at some point, obviously, those energy costs, they flow through to other things, right? At the end of the day, you know, the prices that you pay in the restaurant have to reflect that, the prices you pay for something that's delivered to your front door, whatever it may be. And so, you know, yes, I think they have been embedded in there, but, you know, if people start to look out and say, well, things are always going to be that much more expensive, that becomes a greater problem, as opposed to, well, you know, they're high now, and I think we're bringing them down. You know, I don't know that the belief is starting to fade, maybe that we're going to bring them back down, right?
Yeah, but if it comes down, it's still gonna go back up. It's always, inflation is always gonna do that, isn't it?
To a certain degree, but you know, and you don't want inflation to be zero, because that would be problematic as well, but you know, that would then be deflation. But you know, being well above that 2% target for an extended period of time can be a self-fulfilling prophecy, I guess, is what I'm starting to say.
You want it to do this.
Yeah.
want
You want it to go up,
steady
but
go,
very steadily.
Predictable, I can plan for it type of way.
Right. And we have not been in a predictable, I can plan for it type of environment here more recently.
So,
Not a lot of it.
So to that end, next page is a similar theme here. You know, commodity prices also seeing significant price increases. Obviously, a lot of that is sort of the energy complex. But in addition to that, a lot of other commodities, some of the base metals, things that are being used in the AI build out, you know, copper, aluminum, all these things that might go into that build, those are seeing big increases. Some of those things are also sourced from the Middle East, at least in part. So through the Strait of Hormuz, potentially, aluminum's a big one, fertilizer's a big one. So that is also playing through into the inflation story to a degree. Slide 7, again, we've been talking about this for a while, but it continues to be, I think, kind of the driving force behind the economy. CapEx spending on AI is really, really driving the economy right now, that build out. And you can see, obviously, the enormous amount of dollars that are being thrown at that infrastructure from the hyperscalers on the left-hand side of this chart. Similarly, if you look at the right-hand side, those hyperscalers, which had enormous free cash flow or do have enormous free cash flow, they have more recently been spending virtually all of that on the build out. So that free cash flow is rapidly disappearing. And that can be a little bit of a concern as well. Are they overdoing it? Are they going to be able to afford all of this? We've seen some of the financial machinations, shall we say, that people have been using to finance some of this stuff, which are concerning in some ways. And so something that we are certainly keeping an eye on as we go forward.
is that actual building data centers, or is it, you know, going through the process necessary to purchase land that may never get?
It's all of the above, right?
But how, I mean, is it a greater extent on building or a greater extent on purchasing land that they might not ever get to build on?
I think it's probably a greater extent on building right now, but I don't have numbers specifically to back that up, Cindy. Might be a better question for Ethan. He might have a better answer for that, because we look at things in the real asset side there. And I've been talking to some of the digital infrastructure providers. But I think, you know, most of it's real build. But to your point, there is certainly a large segment where people are going out and going to do what I'm going to call spec data centers. So they're trying to get permitting, they're trying to get power agreements and land and doing that. So there's definitely an aspect of that as well.
Just seems there's more risk once they get built out.
There's
And then
certain,
they're over.
we would view it as there is more risk in sort of that spec side of things where they're trying to get something done because you've got, you know, people saying, well, maybe I don't want it in my backyard, maybe I can't provide energy to it. We would gravitate towards the data centers that are in the tier 1 markets that are fully built out, that are 100% leased. And, you know, we're confident that there is go forward demand. Whether the demand materializes, I think to your point, for some of those people who are developing these things, a riskier proposition.
Yeah. Depends on the time of the investment.
Yeah. Slide 8, the yield curve here, I don't often show it, but as Paige pointed out, it's pretty important these days. People keeping a close eye on this. We hit the $40 trillion in the national debt last week. I think even more interesting than that was that the Treasury Department announced last week that they would double the size of their long dated bond buybacks. This was pretty clearly an effort to hold down yields in the long end of the curve. I think they deny that kind of at this point and have backed away from that idea, but nonetheless, I think the bond market absolutely takes it that way. And that is concerning because it starts to say, well, the interest payments on the debt, that $40 trillion worth of debt that we have, is a concern to the government. And, you know, people are starting to demand more yield there. They don't want to pay higher yields. Maybe they can't, you know, the only way they can pay higher yields essentially is they're going to print more money, which again leads to inflation. So that's a concerning development that I think the market is pretty laser focused on at this point. And it's, I would argue, a sign of essentially we need to get our fiscal house in order as the US government. And that doesn't mean, you know, I guess not to be overly political or anything, but I don't see any way that that's happening, at least in the short term. I don't see any sign of that happening at this point in time. And, you know, probably need to get real about that at some point or another. But it's certainly a signal to the investment markets.
It's a little like making your mortgage payment with your credit card.
Yeah.
Can you do that?
For a little while.
1 points.
Never did do that.
So any questions about the economic environment before I jump into the investment stuff here? Mark, you look like you have a question, Mark.
I don't have a question.
Okay.
Not a concern.
Okay. Slide 9 here, assets under management by asset class. Just under 32 billion. We're a little bit over 32 billion as of today. No real big changes or anything to point out here from prior quarters. Same with the following slide by participant type. Obviously, pension fund is the largest one here, and the rest of the players that you see in the wheel chart here are similar to what you've seen in prior quarters as well. Assets under management by pool. You can see that as is pretty typical, CAP kind of continues to grow. I would say, you know, separately managed accounts, trust fund, STIP, pretty much steady as she goes. Maybe a little bit of growth there, but not as much as we see in CAP. It's typical. Focusing more on the pension on slide 12, the asset allocation. We're well within all of our approved asset classes ranges. We were a little bit overweight domestic equity at quarter ends. Part of that kind of being the good run that we had there, as Paige was pointing out, particularly kind of into quarter end there, as there was some optimism around the Middle East situation. A little bit underweight core fixed income. More recently here, we have tried to get back towards the midpoint here in domestic fixed income, taken off in July and August, about 125 million in domestic. Moved a good chunk of that to core fixed income. As yields kind of were bouncing up there a little bit and a little bit to non-core fixed income, but kind of sitting pretty close to the midpoints in the range for the most part here. Broadly. Slide 13, kind of the same story with a different picture here, but well diversified across all the asset classes. Nothing particularly interesting to point out overall here. Slide 14, pension net performance, strong dollar value add over all timeframes here, well in excess of our net cash need, which is of course the benefit payments for the participants. So obviously a very good place to be and what we want to see. Pension net performance on slide 15. Yeah.
Question on that, John. So
Sure.
right now you've got dollar value add.
Yep.
In the positive. Do you ever model that out and say, does that ever change, or do you ever look at that and say, what do we gotta worry about here?
The dollar value add from the portfolio growth or what we're paying out to participants? Or both?
Well, okay, so where does, because the number of participants
Mhm.
relative to retirees.
Yeah.
Keeps diverging, right? I mean, there's
Yes.
fewer participants versus retirees, and you gotta pay out the dollars, so.
Yeah.
Is there a switch about, you gotta continue to add from the investment side a lot, you gotta rely on that a lot more than.
Yes and no. So if we look at the participants, so I think I've mentioned this before. Right now we're in the midst of kind of the baby boomers retiring. That, if you look at, it's kind of what I would project. If we get to, I'm gonna call it 2030, 2032 timeframe, that starts to roll over. Okay.
Right.
So we would expect, and we've been seeing it. I forget, there's a chart that I've shown in the past when we kind of meet with the PERS and TERS, where we've seen the benefit outflows tick up year by year as a percentage of our assets from, call it 3% to 3.5%, maybe
That goes back to, pretty soon the 3%ers are gonna be kicking on.
It's exactly that. Yep.
Yeah, okay.
And so that starts to roll over in, let's call it the early 2030s, I believe. And so, yeah, I don't foresee an issue in that respect,
Okay.
but it's something we've been very cognizant of because it's hard to predict and it's hard to know, but I would say what we've expected thus far has happened. It's consistent with what we would have thought. We haven't, and yes, we look at it every year especially when the actuarial reports come out from PERS and TRS, to make sure that trend line is not dramatically changing in some way, shape, or form. Yeah,
Okay.
absolutely.
Thank you.
Bet. So performance on slide 15, I would echo Becky's comments that, super strong absolute returns here in the 1 year and 3 year at 10.5%. Obviously well above our actuarial hurdle. It's been quite a volatile ride. And I would add the obligatory, probably don't expect those kinds of returns every single year because we,
You never had.
law of averages, we probably revert to the mean here at some point or another. But the more important point here, as always, looking out at the 10, 20 since inception numbers, we're well in excess of our actuarial hurdle. And that tells you that we are achieving our primary goal, which is to, hit that 7.3%. So that's the good part. So questions on pension before I move on?
It's better than it was 20 years ago.
It is.
I mean, overall.
Partly returns, partly, as you know, we've had the state increase contributions and things as well. All of those things have helped. We've obviously modified the benefit structure. So all of that in conjunction, yeah, we look to be in a pretty good place. So slide 16, assets other than the pension here. Again, kind of the same wheel chart that you see every quarter. No real big changes in any of the players here. About 14.5 billion at this point. Slide 17, the STIP portfolio. Again, similar to most quarters, well diversified. We just heard the story kind of from the fixed income team. You might notice that the weighted average maturity of the portfolio at 87 days, quite a bit higher, I think, than it was prior quarter, just taking advantage of some of the higher rates there. But we're in good shape with STIP. Slide 18, STIP performance. You know, good performance across all times frames here versus the benchmark. I would note the 1-year performance there at 4.2 versus the 4.02. Really strong outperformance versus the benchmark this go around. So that's nice to see. Again, we won't necessarily hold Kirsten to that on the go forward, but good for this year. Questions on STIP? All right, moving on to trust fund on slide 19. Again, asset allocation here, well within all of our approved asset class ranges. You can see that private credit ticked up a little bit as we've had a few more commitments being drawn down there. Similarly, real assets, at least getting to the middle of the range here, a little over 3%. So that is good as well. Nothing much else to point out special there, I don't think. Trust fund performance on slide 20. Again, good performance here versus the benchmark across all time frames. You can see the yield at the bottom there, a little over 4%. Yield to worst on the overall portfolio, at least within the core fixed income portion, probably around 5%. So still some room probably to continue to move yields up a little bit as things roll off and we're able to invest in higher yielding assets. But I think hopefully the participants are happy with the trend here more recently. Questions on trust fund? All right, state fund on slide 21, sort of similar story, well within all of our approved asset class ranges. Again, private credit, we've seen some commitments pulled down there, so starting to move up a little bit. In a good place overall, I think, with state fund.
So, but you're nearing the top of your range on real assets. Have you ever had a discussion about increasing that?
I believe, if I recall, the top of the range there is 4%. So we have a little bit of room yet for some things to pull down there as well.
Okay.
I think if I recall, we're probably close to fully committed there. It's just, you know, people haven't necessarily drawn that commitment, and obviously we don't want to go right through the wall. State fund performance, again, good across all timeframes here. We did meet with state fund last week. I think the relationship remains good. They'll be discussing their dividend at the September 3rd board meeting that they're having. Well, that'd be next week, I guess. So we'll see what they come up with there. They've got a few new board members. Karen Craig is the chair now.
She's the chair now.
She's now the chair. Richard stepped off, and that's what I know. Yeah.
And they did appoint board members, because last time I heard they hadn't.
They appointed 3 new board members. Yes.
So
They've been appointed.
enjoy.
Yes, I will. They're always nice to me. So.
You're
adorable.
What's that?
That's because you're adorable.
I never really thought of John as adorable. I'll stick with brilliant, however. Would you take brilliant over adorable?
I think I would.
See?
He'll take what he can get.
I'll take whatever. That's a very fair point, Paige. Yes, I will take whatever. Compliments are few and far between around this place, I can tell you that.
He's Dan.
So, yeah,
What the hell?
yeah.
We're gonna talk
I
later.
reserve the right. He's not gonna say anything else. He's gonna get himself in trouble. All right, so finally, for me anyway, slide 23, CIO update, markets, talked about it a bunch, you know, the big things happening, and certainly as Paige pointed out, the leadership change at the Federal Reserve. It's keeping a close eye on that and the communication that happens there. We obviously have a lot of ongoing geopolitical events and volatility, and the AI capital spending cycle is a big thing. I'm keeping a close eye on, I think, as the market is, you know, how's the bond market react and going the long end of the curve to kind of the debt situation that we find ourselves in, and we'll see how that plays out. I don't expect anything to like break in the short term or anything like that. I think it's kind of a slow moving train as it has been for a long time, but you know, that day of reckoning gets ever closer, I guess, if you will. So we'll see what happens there. Staff projects, I think we touched on it a little bit earlier, but the defined contribution, deferred comp plan stuff, we made the transition on July 1st. It was a very heavy lift for the public markets team, for the core fixed income team, for operations. Broadly, extremely well. I got very little sleep around the couple weeks at the end of June and probably the first week or two of July. But you know, there were hiccups here and there, lots of communication things, burning up the phone lines between you know, our custodian, the plan administrator. I talked to Bill Holohan more than he probably ever wanted me to talk to him. But in the end, everything, you know, moved to the right place. It moved on time, and everything went quite well. And kudos to Jason and his team, John and his team, Aaron and his team of making everything work and standing this thing up for something that we have never done before.
I suppose it helped that the markets stayed very positive too.
It didn't help, or it did help that, you know, things were relatively smooth around that time frame. So we didn't have, particularly on the fixed income side, where we were standing up that internal bond pool, you know, virtually overnight. I will say as well that, you know, you all approved the ETFs last meeting or meeting before, I don't recall, but that was extremely helpful, went really well. Continues to be a great tool to have. We use it daily in that, particularly in that DC portfolio, but also across the other portfolios at this point. So it's been a really good tool to have in the toolbox. So thank you for that.
Participants moving towards STIP, are you seeing?
Yeah, I would say we have seen a fair amount of activity into STIP. Core internal bond pool, I've been surprised sort of at the flows that we've had there at times. But it seems to have kind of settled down and leveled out a little bit. Yeah, you know, business as usual, I guess, for the most part, and yeah, all good. We've met about asset allocation 2 weeks ago, Paige, seems like a lifetime ago almost, but we'll be bringing that to you in October, as mentioned. And then, of course, we continue to build out a lot of our AI dashboard stuff, as we've talked about in the past, and that continues to go well. Also, internship, we just had one this year on the investment side anyways. John did a great job, MBA student this year at U of M. He delivered a bunch of impactful projects for us, some in kind of the AI space, others just kind of doing research and things for us. But I think it was really good across the board. So Rob has kind of been spearheading that side of things for us on the investment front. And he's done a great job with the interns. So if there's no other questions of me, I will turn it over to Aaron.
Eric, members of the board. I am Aaron Kirpin, Director of Investment Operations. I'll go over macro attribution on page 24. To get right into it, with strategic asset allocation, All benchmarks except real estate provided positive contributions to the pension's policy neutral return of 13.2%. Moving on to tactical asset allocation, about 498 million of equity asset classes and 32 million of fixed income cash asset classes were sold during the last year to fund the pension's net cash need of about 565 million. In the aggregate, the overweighting, underweighting of the asset classes relative to their benchmarks decreased the pension's portfolio's return by about 38 basis points, with the underweight to domestic equity providing most of that underperformance. Which really goes back to, we've kind of been underweight domestic equity over this 3-year period, even though we might have been a little bit overweight here recently. Style selection, my comments are still generally the same from my last update, so I will move down to manager selection unless there's any questions there. What I would point out in manager selection is private investments, the manager selection effects underperformed by 227 basis points. That is up kind of a lot from my previous update, but again, that's not real surprising given the equity market, public equity markets have been on a tear for these reasons we've kind of been discussed already today. Real assets underperformed by 40 basis points due to the public infrastructure and public commodities portfolio benchmarks significantly outperforming back in Q1. And lastly, in real estate, the private real estate portfolios were the primary driver of the 20 basis points in outperformance. So unless there's any questions, I will hand it off to Jason. Thank you.
So I have a question there. So with deferred programs and the defined contribution, has that changed the work that you're doing? Are you looking at that differently? Or are you grouping it with all these other attributions?
It's completely separate. This macro attribution is just for the pension plan.
Okay. Okay, but you are monitoring those performances as well?
Yeah, we're monitoring the performance of the STIP portfolio and the new BOI core internal portfolio that's being managed specifically for both those DC plans.
Okay.
Thank you.
Good afternoon, Mr. Chairman, members of the board. I'll start with domestic equity on page 27. Remember, the first quarter of this year was a story of geopolitics, risk-off sentiment regarding AI. Equity markets had a very poor quarter. The second quarter was just the opposite. Tech stocks rallied, energy stocks retreated. Generally speaking, over the last year, just about anything AI has done extremely well. But if we dig a little deeper, things get a little more interesting. So while AI has been a strong theme, we've also seen outsized effects from just a very small number of stocks, which I'll try to hit on. I noted here too that over the last 12 months, value stocks have outperformed growth, which might seem odd given the rally we've had in tech and AI. But the fact is that the Russell 1000 Value Index has tech exposure too. It has less of it than the growth index. But a few of those value tech stocks put up unbelievable numbers over the last year. We're talking a few stocks with 500%, 800% returns. One stock was up almost 5,000%. That coupled with mixed results from the Magnificent Seven, a couple of those mega cap growth stocks were down more than 20% over the last year. Put those two together, and that's what contributed to the outperformance of value over growth over the last 12 months. The same is generally true for the outperformance of small caps over large caps. A couple of those strongest performers are small cap stocks that did extraordinarily well, while the mega cap Magnificent Seven was mixed. But along with this enthusiasm is strong earnings growth. Earnings estimates for 2026 continue to rise, which has also helped support the stock market. Turning to page 28. So the top left shows our sector exposures versus the benchmark. Very small differences, which is what you'd expect from a passive portfolio. We're a little underweight tech due to the overweight to small caps. That overweight is shown in the bottom right-hand corner. We did trim small caps in the quarter, so the size of that overweight is down a bit from where it was in the first quarter. Page 29. Valuations were up, and we've been on an upward trend since the fall of 2022 with a few blips in between. I don't like to make predictions, but I think we could see something in the last half of this year that we haven't seen for a while. We could see a rising stock market and lower PE multiples. And actually, that's what's happened so far here in the third quarter. We've seen earnings estimates rising faster than stock prices, which leads to a lower PE ratio. Concentration in the largest stocks is still high. 38% of the S&P 500 is in the top 10 stocks, which is close to the same as it was last quarter. Any questions about domestic equities?
So you're expecting to see a rising market, stock market and lowering PE.
I'm saying you could see that.
Okay.
You've seen it so far.
Conviction, Jason.
That relies on predicting that the market's going to keep rising, which may or may not happen. So
Okay.
prices go down, you're probably going to see lower PE ratios too. So. To international equities on page 30. International markets saw many of the same themes we've seen in the US with AI and semiconductor stocks booming. But unlike in the US, international large caps did better than small caps over the last year. But as in the US, value outperformed growth over the last year. So while growth did do better in tech, several sectors in the value index, industrials, consumer communications and financials more than made up for that gap. And like last quarter, we said that EM outperformed developed, but that didn't quite tell the story. There were 3 stocks that drove all the outperformance of emerging markets in the first quarter. That was also the case in the second quarter and has been true over the last year. Those 3 stocks, all large cap growth tech stocks, all are in the EM index. With respect to currency, weaker dollar was a boost to international stock returns last year, and this year currency has been a slight headwind. On page 31 and in the upper left, you see our slight overweight to EM. We've been close to 2% overweight for a couple of years as our managers have increased their EM exposure. Again, this is not an active decision on our part. The same with our overweight to small caps in the lower left. That's due to the aggregate positioning of our managers. The upper right shows our sector exposures versus the benchmark. Small differences with overweights in consumer sectors and underweights to tech and financials. And the bottom right shows our split between active and passive. If you remember, policy states that we must maintain at least 35% passive. The weight in active came down in the second quarter as we used index funds and ETFs for liquidity. 32, valuations were up in the second quarter for international stocks, which have typically traded at a discount to US stocks. This discount has been larger than average for several years, but outperformance by international for the last 18 months or so has helped narrow that gap some. The discount is currently at 31%, while the longer term average is closer to 20%. Any questions about international? Turning to non-core fixed income on page 33. US high yield bonds had a decent quarter, but again, convertible bonds and emerging markets debt were the strongest performers. Over the last year, our convertible bond portfolio returned about 17%, and our EMD portfolio about 11.5%, which compares to US high yield returns of about 6%. Continues to be a benign credit environment. Default rates remain low for US high yield bonds. In 2023 and 2024, we saw lower quality credits outperforming, but over the last year, that has flipped. Higher quality bonds have done slightly better than lower quality ones. Page 34, no real notable changes in this page. On the left-hand side, you see the biggest sector differences that come from our exposures to the non-high yield strategies, preferreds and emerging market debt. Same with the chart in the upper right. EMD and preferreds have investment grade exposure, which shows up in the BBB and higher section. And the bottom right shows our exposures by strategy. Over the last couple of years, we've trimmed high yield some as spreads have tightened. We've added to emerging market debt a couple times, which has been offering higher yields. And we've added to convertibles. If you remember, we funded the convertible strategy in 2023. They have gradually been building up that allocation. Page 35, high yield spreads have bounced around a little this year. up 50 basis points in the first quarter, down 50 basis points in the second quarter. But spreads remain below 300 basis points, so still at levels considered to be tight. But even with the tight spreads, yields are reasonably attractive, around 7%. Any questions about non-core fixed income? Turn it over to you.
Thank you.
Hey, Jason. Hi, everyone. Hope you had a nice summer. Welcome back. Good to see you. I'm on page 36. Yeah.
What?
Kids start school tomorrow, so it's technically over for me.
Well, not for me.
I love it. Must be good to be retired.
6 weeks of good golf left.
Yeah, good stuff. So I'm on page 36. We've got our ownership breakdown in real estate. AUM by plan on the upper left, dollar value add on the right, performance, and some of my thoughts below, which I won't walk you through, but they essentially say it all. You know, the market is recovering. It's brought, you know, it's highly asset specific. We've got this high interest rate environment that's probably going to be sticking around for a while, so we can't really expect a lot of cap rate compression going forward. It's really going to be dependent on rolling up your sleeves and intensively asset managing these properties. In fact, if you look at the trailing 1-year returns in the ODCE and the NCREIF National Property Index, the annualized returns are highly weighted towards income versus any sort of capital appreciation. Which is good because we have vertically integrated operators in our portfolio. We have a bias there. These are folks that, you know, own and operate the properties, you know, at the property level. Everything's vertically integrated, incorporated. So that's good. And the other thing is, you know, transaction volumes are picking up, debt's available. Development has been deeply muted for the past couple of years across most property types. Sans data centers, perhaps. And so that's a great thing from a supply demand perspective. So that portends great things for our portfolio going forward. That's kind of big picture. It's nice to see some positive numbers here for the first time in a while. Happy to answer any specific questions if you have any. Otherwise, we'll flip on to the next page, where we see our asset allocation. In the upper left, we're well within policy constraints. We see our diversification by property type in the upper right, and then our net asset value and cash flow behavior within the private real estate portfolio through time. Specific questions, happy to address. Otherwise, we can just keep rolling. Seeing none, I bring you to page 38, where we have real estate valuation. I've presented on the top half of the page, the Green Street's commercial property price index. The second column from the left, you see the past month. That's indicative of sort of just a muted capital appreciation indicator there, just zeros down the line. I'll draw your attention to the lower part of the page. And the second part of that graph on the right, you can kind of see capital prices just sort of flatlining more or less, maybe a little bit of a steep curve up and to the right, but just sort of muddling through. So pricing stabilization is occurring. And as I indicated, you know, really intensive property management at the asset level is really what's going to drive return for the foreseeable future, in my opinion, in this elevated interest rate environment. Really, you know, focusing on expense control and growing rents and grabbing for any sort of incremental income opportunities at the property level through time. So a pretty good story relative to what we've discussed in the past handful of quarters. Happy to address any specific questions. Otherwise, we'll roll to new commitments where you'll be hearing from both Rob and I. Yes.
Just
Hey, Dan.
quick question on multifamily. I've read that there's some issues in multifamily. Vacancies are up in certain areas. I think maybe because of immigration policy and some other things. Are you seeing any of that? And how much, I guess, do we have in that area or those areas that are having concerns?
Yeah, sure. So immigration is an issue. I mean, I think there's been some net people leaving the country relative to folks coming in. I would say that's not a primary driver of the vacancies that we've seen across the portfolio. It's a diversified portfolio across the US. Most of it has been driven by, to the extent we have issues, which we do in the portfolio, it's been driven by just overbuilding and largely in the Sunbelt markets, which had a lot of positive attributes during COVID and leading up to COVID that just led to overbuilding. That's coming down. I think national vacancy in multifamily, national vacancy is probably 92 to 93%, depending on who you talk to, which is a high number, but historically high, which is, high occupancy, but the vacancy is historically high. That's beginning to stabilize. The last 2 quarters, we've seen net positive absorption in the space, but there's still quite a bit of wood to chop in some of these Sunbelt markets, Phoenix, Tampa, Austin, for example, being a couple of places that are ground zero, no doubt, for some significant overbuilding and some stress, if you want to call it, in the space, or disruption. But that said, these are all still good growth markets, employment strong, and so it's just a matter of time, and things are rebounding. Annualized rent growth in multifamily last year was slightly positive, which was probably the first time we've seen that broadly across the nation for a couple of years. So it's getting healthier, but we've been chopping through wood in this oversupply issue just from overbuilding. I would say immigration's a smaller piece of that for sure. But we're chopping through it, and it's on its way back for sure.
Does that generally apply in Montana too? Do you know?
Cindy, I don't have a good bead on what's going on in the Montana multifamily space. We don't have any multifamily exposure in Montana. That's somewhat deliberate, somewhat just circumstantial. It's not a huge institutional market. The markets are small. They're not super deep, super liquid. They don't attract a lot of institutional capital, or the types of folks that we would historically invest with. So I'm sorry. I mean, I can certainly reach out to some folks and try and get you some more market specific data if you're super curious. We have fingers and tentacles throughout the industry. I can probably get you some information. Just let me know, and I'm happy to follow up.
There's for sale, for rent signs visible on streets in Bozeman.
I was gonna say in Bozeman, I think that's absolutely true. Rents are down.
A few years ago, there was not anything for rent.
Rents are down, and it's probably the same reason Ethan was talking about, is
Yeah.
lots of apartment buildings have been built in Bozeman the last couple of years.
I think we get to that point, but whether or not it's going to be affordable for a lot of the people that are looking for apartments is a whole nother story.
We see less lake deposit activity out of Gallatin Valley than we do other parts of the state for multifamily. I'd say Kalispell, Billings, Great Falls, Missoula, where we're seeing most of the activity. Gallatin, I mean, even for us, what we know about construction, it's more expensive to build there. How you blend, you got to get the right project with the right tax credits. There's got to be some form of subsidy, or you're charging market rents, and that's not attainable down there.
Well, and the cost of land is higher than Billings. Thank you.
Moving on, sure, no problem. Just let me know. I'm happy to follow up. So since we last met, we made 2 new commitments to Marcus Capital Partners 5 and DRA Growth and Income Fund 12. These are both re-ups. DRA has been a long-standing relationship of ours. You'll hear more about that from Rob. Marcus Capital Partners is a re-up. We committed to their fund for $50 million a couple of years ago, returning about a 12.7% IRR to the portfolio so far since inception. So quite accretive. This is a vertically integrated real estate shop based out of Boston, founded in 2008, 100% employee owned. Focuses largely on multifamily and industrial up and down the East Coast, major markets on the East Coast, from call it Raleigh, Durham, up through Boston, a little bit of New York, but have been fading New York for the last couple of years. But a great team. We've got a lot of conviction in them. Great relationship. So
So primarily East Coast.
absolutely, strictly the East Coast at this time. Yes, sir. Happy to answer any questions that you may have.
But so we're gonna hear about DRA as well.
Yeah, Rob's gonna come. I was just about ready to bring Rob up. He's gonna walk you through DRA.
Thank you, Ethan. Chairman, members of the board, good to see you all. Rob Sampson here. I'll try to be brief and efficient. As Ethan mentioned, DRA commitment of $50 million was made on July 1st, 2026. As you can see here, this is a longstanding relationship for BOI that goes back almost 20 years and has been one of our better performers in the real estate book throughout that time. The strategy has remained largely the same since the inception of the firm, very focused on buying right in the cash return profile, or the cash return portion of the return profile. This is a diversified allocator, one of the few remaining high conviction folks that follow that strategy in our book, and that means they're going to target mainly multifamily, retail, industrial, and office properties across the whole nation. With that said, are there any questions about what you see in the brief in front of you? And if not, I'll turn it back to Ethan to go over real assets.
So they're national versus East Coast.
Correct. Okay. All right, not hearing any more questions. Ethan will walk through real assets.
Thanks, Rob.
Right, just when you thought you were done with me. Real assets on page 40. Again, AUM by plan, upper left, dollar value add on the right, performance, and some bullet points, which I won't walk you through verbatim, but maybe, you know, big picture, OPEC continues to roll back its production cuts. Whether that's a moot point or not, we'll see. I guess Iran and Oman just came to an accord, and so maybe we'll start seeing oil flow through the Strait of Hormuz like it had prior to February of this year. The UAE formally left OPEC. Big picture on the energy front, you know, lots of questions with fossil fuels and supply lines and so forth. So everyone's sort of rejiggering and rethinking about energy security. There's renewed interest in renewables. The draws on strategic inventories and reserves have been dramatic. We're at all-time lows, given sort of, you know, the need for refined products and a lot of the Ukrainian drone activity in Russia and some of the moratoriums on them exporting diesel and fuel. That has, you know, led to our refinery capacity running full tilt. That's part of the reason why diesel and gas are still as high as they are, because we're just trying to supply the world's voracious appetite for diesel and gas. On the other side of the equation, you know, aggregates are performing well, leasing rates in rail is doing well. I'm happy to answer any questions as it relates to anything on this page, anything within our portfolio, anything we're thinking about doing. Otherwise, we'll keep rolling on.
John, what were we gonna ask Ethan?
AI.
Is it a data center related question?
Yeah.
I don't remember what it was, but
Where the bubble is on the spectrum, are the dollars in AI in acquiring land, or are they built out? Or somewhere in between?
well, a lot of I think it was around the AI CapEx spend. A lot of that is people buying. So when you think about these hyperscalers or these cloud service providers, some of them are self-developers. In fact, most of them self-develop, but they can't all self-develop. So a data center, a lot of this CapEx spend is really on chips, fiber optics, servers, server racks. They then go lease the data centers from data center providers. So, I mean, when you think about our data center exposure, these people are developers, they're owner operators.
Of hardware, not bricks and mortar.
Of the buildings themselves.
Okay.
Of the powered shells is sort of industry nomenclature where they sort of tilt up the walls, they get the interconnection to the grid, and then it's always, more often than not, actually probably 99.9% of the time, it's the user of that space, think NVIDIA or Amazon or Oracle, who is then charged with actually building out the inside of that space to their internal specs. So they're responsible for buying all the chips, buying all the servers, all the fiber optic cables, putting it all together and maintaining it. The data center, the owner and operator of the building does not. It's called a triple net lease. And so they'll provide the building and the power, but everything that goes inside, which is, I think, in upwards of 80 to 90% of an overall data center build, is the responsibility of the person leasing that space. And I saw a stat today. They sort of price these out based on kilowatt hours, and per kilo, or maybe it was megawatts. Pardon me, it was megawatts. It costs anywhere from 8.9 to $23.3 million per megawatt to build one of these data centers. And most of that cost is borne by the user of the space, not the actual data center provider who's building the building and putting the power in place. So that spend, I mean, it's out there and it's huge and it's a big driver. But as it relates to our data center exposure, I would say it's not a huge risk in our book. Most of our stuff is highly stabilized. We do have private equity type investments in data center platforms. And we're also, companies that own and operate as well as develop and lease data centers. And we're looking at adding to that position in a differentiated sense, whereby we'll be looking at buying stabilized data centers that are existing and are already leased, have been owned and operated, are in tier 1 markets, and are paying income, an income stream to the fund as a way to just diversify our just overall data center exposure. And we won't be taking development risk or risk that we won't get power, risk that we won't get a user because we can't get power, because we can't get transformers or generators, because all these supply chains are backed up and there's this massive demand. Because that's where the risk is, I think, in taking this sort of blind pool development risk, if you will. And I don't feel like we have a lot of that in the book.
Good to know. Thank you.
Yeah, sure. Any more questions? Okay, the following page, characteristics. Our real assets asset allocation within ranges, our domestic and international diversification, in our net asset value and cash flow behavior through time for the private assets within the real assets program. Happy to address any questions. Seeing none, we'll take you to the valuation section on page 42. Again, I've shown at the top here the historical price behavior of oil and gas. You can see on the right, sort of oil rising during the inception of the war and sort of hanging around and then dropping off when the MOU was signed and then spiking back up. I introduced lumber down below that. Historically, I'd shown aggregates or the price of saw timber. I thought it might be good just to see another thing that we think about, so we have lumber, we have timber, we are sort of exposed to the housing market generally. Prices have stabilized from their COVID highs, but they've, maybe as an indication of the inflationary environment we're in and the costs that the home builders are seeing, which has led to muted home building, prices have stabilized well above pre-COVID levels. So that's just a sort of a good picture to think about things. Happy to answer any questions. So we'll go to commits. We have one. Before we get into that, I would just like to let you guys know that in addition to new commitments, we actually had a disposition from the real assets portfolio. We've had a position in a timber fund for about the past 15 years. And we just today got an executed assignment agreement of our entire position for full value as of the latest mark, which was 630, which was just came out the other day. So we'll be getting a big distribution, which we'll be able to redeploy into higher yielding other opportunities. Performance met expectations, and we're pretty happy about it. So just wanted to let you guys know that. Happy to take any more specific questions offline if you're interested. Otherwise, I'll turn it over to Rob and he can walk you through this most recent commitment we made in real assets. Thank you very much.
All righty, I'm back.
So, May 12th, 2026, we made our first foray into the private infrastructure debt space with Copenhagen Evergreen Credit Fund. This opportunity is one that'll provide the real assets book a way to diversify away from equity exposure while also gaining some downside protection and current income. This is an open-end vehicle with a group and CIP that we know very well through investing in their equity funds and funds 4 and 5, and whose experience and capabilities in the renewable space allow them to understand it much better than many other lenders. As a refresher on CIP, this is a group this is a global firm. The strategy will mainly focus on North America and the continent of Europe. SIP is a global firm with an industrial heritage with a completely integrated investment as asset management teams, and one of the main benefits that we really viewed them in this fund from was that they have the ability to step in and operate an asset should something happen, and this is a space where many lenders do not have that. So happy to take any specific questions further on CECF. All right, hearing none, I will hand it over to Thomas to cover private investments. Thanks, everybody.
Thanks, Rob.
Yep.
Good afternoon. I was told to keep it short and brief. Thomas Winkler, active private investments.
How'd you look at me when you said short? That's not nice.
You never hear what you're gonna hear. That's not what anyway. Private investments. I'll start on slide 44, similar picture here. Just like to highlight, we crossed the $3 billion NAV mark in the asset class. And again, reminder that's across pension, trust fund, and state fund now. Within state fund, we call only private credit. We are just shy of about a 1% allocation in both of those plans, but well on track to reach our target of 2%, hopefully by the end of the year. So we're moving well ahead there. The asset class overall has added significant value for the pension. As you can see in that bar chart on the right, it's a $2 billion add over the last decade. Significant dollar value add for the plan. In terms of performance, long-term, the 10-year numbers slightly improved quarter over quarter compared to last time we spoke, and remains within expectations. It is beating our actuarial rate of return and therefore accretive to the overall performance. Just a reminder for the folks here and online, in terms of our philosophy and how we invest in the asset class. You keep hearing this from me all the time, but we do focus on the small end of the spectrum in terms of fund sizes and managers. With that comes allocations to smaller companies. The folks are traditionally able to buy those below market averages. We're using lower leverage. All of those factors play into overall performance expectations. And like Ethan and Rob always point out, we like folks that have actually an operator background. If things don't go according to plan, they can step in and run a company if it needs to be, and just focus less on financial engineers and just leverage vehicles. Just wanted to highlight that and remind everybody of overall philosophy in the portfolio. Are there any questions on this particular slide? I'll move on. I don't see anything, nothing online. We're on 45. The characteristics of the portfolio should look pretty familiar. The slide, no big changes here quarter over quarter. Well within our ranges per investment policy, strategy, and geographical diversification. Again, don't change quarter to quarter. Well within our designed allocations. We like where we are here. Should there be any need for us to change or make a shift in any way, which certainly will communicate that very clearly, but nothing is planned at this point. We're going to go steady as she goes. Any questions? I'll move on quickly. Overall market environment valuations slide. Again, should look somewhat familiar. I did add a couple of averages there on the right-hand side. I'll get to that in a second. Overall market deal activity, second quarter saw another slowdown. We were slightly optimistic last quarter that we're turning a corner here. That has not materialized for all the reasons that were discussed here today in terms of uncertainties around energy, inflation shocks, AI disruptions, cost of capital, interest rates, all of those good things tended to put a damper on deal activity overall. It's not dramatic. I mean, look at that bar, the 2026 bar again, that's year to date for the first half. So we're kind of on track to the long-term averages, but certainly behind some of the record years of 21 and 2025. Valuations overall holding steady on the right-hand side chart, and I added those lines there. You see that's the 5-year average for valuations from 2016 to 2020. And for the subsequent 5 years, you heard that comment from me last time as well, that the valuations overall holding steady. However, we're about 2 turns higher than we were pre-COVID years. So that certainly, in our mind, implies that the managers and us, we can't simply rely on higher valuations to create returns. Looping back to my earlier comments, we have to focus on actual operators who can improve companies and not just lever a deal up and hope that the valuation multiple goes up and we're making a return. Exit environment continues to be challenged. We have, however, and again, this is a small sliver of hope here, if I may be optimistic, seen 5 exit deals from 5 GPs in our portfolio in the last 2 weeks. So folks that have actually sold the company. Now that may not be indicative of the overall market, but we certainly have seen some uptick in activity of folks actually selling deals and getting some money back to us.
So when they sell, you get the money, you get
Yeah,
investment back then?
yeah, ideally, yes.
Ideally.
That's traditionally how it works, yes. If there's always going to be a lag, right? When I see the deal exit announcement, they're gonna have to wait for regulatory approval. Potentially, there's lawyers involved. It takes some time. So we usually see distributions, I don't know if you have an idea, a month, 2 months later, but it takes some time. At least something's happening, something's moving. Any questions on that particular page? If not, I'll move on quickly to our new commitments slide. Just one so far. There's our Accolade Beaverhead Investment Fund, and it's really an additional commitment to an existing separately managed account. If you recall our discussion from about a year ago, Accolade is our designated venture capital and growth equity fund of funds. We structured a separately managed account with them that allows us access to certain overflow capacity that the manager negotiates with the underlying funds that we then can allocate through in this vehicle. The primary goal here is to allocate to very early, very small funds that we otherwise would not be able to access directly. And just wanted to highlight the very attractive management fee economics on this that we've negotiated here to give us access to these funds again that we otherwise would not be able to get into for sizing reasons primarily. Happy to answer any questions on the Beaverhead Investment Fund. First investment here was July 2025, so we don't have any performance. Unfortunately, I wish I could show something, but it's marked at cost of 0%.
I have an off-the-wall question. Where do they get these names? And does Beaverhead have anything to do with Beaverhead as we know it? And there was one a while back, I don't know if it was here, but it was Muscle.
Short answer, we name them.
If it's a separate account, we name them.
Oh, okay. Well, you had Muscle Shell a while back too.
Correct.
Which is also a separate account. Yes.
Okay.
All the separate accounts are county names because everybody does mountains and rivers. So these guys get to pick a county for each separate account.
Well, you know, Muscle Shell is a river.
Also, yes.
So is Gallatin, Madison, Beaverhead, Jefferson.
Well, Deer Lodge was until they renamed it the Clark Fork, which I still don't think applies legally.
We'll have to fix that later.
Yeah, officially county names.
So
okay, thank
you're gonna have to, we put these on the smart room. And I couldn't remember all my questions now. I have to write them all down because in the past, you had them right there in front of you, so. It's over. For this meeting.
Good. Any other comment questions I can answer?
I had questions.
Seeing none, I'll pass it over to Mr. Ramasco.
Thank you, Thomas. If I can refer the board to slide 48, where we can see about 3.79% return for the benchmark on the year. The yield for the year started at about 450, ended at about 470. So that rise in interest rates resulted in a headwind to return of about 120 basis points. We got about 50 basis points back from tightening of corporates and structured products. So that's adds together to about that 379 return. For the portfolios that we manage, we were a little bit longer than the index, so we got hurt a little bit more on that movement. Additionally, we were slightly light corporates, so we did not enjoy quite as much benefit from the tightening. But if you look at slide 49, at the lower graph there, you'll see where we did get our money back. And that is that you'll notice that the spread movement in the short end of the curve was significantly higher than the spread movement in the long part of the curve. We were short the short end and long the long end. So that's where we got most of our outperformance. And then generally just the individual security selection provided some of that outperformance as well. Going on to slide 50, looking at the core fixed income, you can see we maintain a somewhat long duration to the index. Not so much a bet on future movements of interest rates, more a bet on the yield curve staying steep and enjoying a pickup in yield by going a little bit longer. Still a slight yield advantage and yield to worse to the index. And we are remain a little bit light to the index in terms of our risk from corporates. The other portfolios, very similar characteristics. Happy to take any questions. Thank you.
All right. Any other questions for John or his team? Okay, if not, Dan informed me that we have some legal strategy to discuss. So at this point, we'll close the meeting so we can discuss that confidentially.
Okay,